Welcome to this edition of Cedarstone Digest. This is Matt Davis, and today we are going to quickly explore a strategy known as asset location. The goal here is to reduce your tax bill without changing your overall risk profile. If we jump right in, there are a few basics to cover to understand an asset location strategy. First is understanding that not all investment gains are taxed the same way. Interest payments from bonds and CDs are counted as ordinary income and are taxed at whatever tax bracket you are in. The tax brackets are progressive, so the more income you have, the more you have to pay in taxes on your investments. Stocks are taxed differently. If you sell them within a year, they are taxed in your income bracket as well if you have a gain. This is called a short-term gain, and you typically want to avoid ending up with any short-term gains if possible. However, if you wait a full year before selling, the gains are taxed at what is known as the capital gains rate, which is typically lower, as you can see on this chart. Also, you do not have to pay capital gains until you sell the investment, so theoretically, you'll never have to pay taxes if you never sell. Dividends are also taxed at this same reduced rate. The most important thing to understand is that some investments are more tax efficient than others. The other important factor you need to understand is that the type of account you invest in also has a large impact on your tax bill. A typical brokerage account, like an individual or joint or trust account, is a taxable account. This means that any investment gains you recognize, whether capital gains or income, must be paid that year. However, there are tax-advantaged accounts, such as IRAs and Roths and other retirement accounts, that you do not have to pay taxes on investment gains. These kinds of accounts can become great shelters for your investments that are taxed at higher rates that we discussed on the previous slide. So what does this look like altogether? Let's take a look at how individuals and even advisors typically invest. If we use a simple example of someone who has $1 million portfolio split evenly between a joint account and an IRA, they are a moderate investor and use a 50% stock, 50% bond allocation, and each of their accounts is invested in the exact same way. If we assume their bonds are yielding about 5% and their stocks are paying about 2% in dividends, the joint account would owe about $5,125 per year in taxes, assuming a 35% tax bracket. Now let's take a look at how an efficient asset location would look. Instead of treating each account the same way, we recognize that we should be efficient with our tax-advantaged account. In this example, we put 100% of our stock in the joint account and 100% of the bonds in our IRA, and now our bonds income is being sheltered and our stocks pay at a lower rate and their dividends are taxed at a more favorable rate. This portfolio would instead owe only $1,500 per year. So why is this important? In investing, there are only so many ways that you can increase the amount of money in your pocket, and most of them involve increasing your risk. Asset location is a way to essentially have the exact same portfolio with the exact same amount of risk, but end up with more money in the end. As you can see from this chart, both portfolios have 50% stock and 50% bond, but the tax bill is over $3,600 less per year. This is something that we do for all of our clients, if applicable. It is too easy to ignore and a great way to add around 0.5% of additional performance annually, depending on your situation. If you have any questions about how this works or would like to find out how much it could save you, never hesitate to reach out to us. Thanks.